What in the hell is going on, guys? It seems like we're in the twilight zone. Michael Burry just tweeted today saying, I was wrong to say sell. A day before FOMC on January 31st, Michael Burry said sell. Now, you know that this guy loves to talk in riddles and conundrums. So did he mean it? What is going on with the market? Is he actually being sarcastic here, or did he really mean I was wrong to say sell? We haven't really heard about him capitulating before. So in this video, in this week's edition of TA Thursday, we're going to go over the chart. Look at what the heck is going on as the NASDAQ hit officially a bull market. Obviously, we can't talk about the recent market without mentioning what happened with the banks and the fact that the Fed actually added almost $400 billion on their balance sheet in 2 weeks. We are due for an update actually today as of the time of this video. But this is what I was saying in my last video and my last live, that the fact that the Fed is now back to QE, regardless if these are loans or not, they are still adding assets to their balance sheet and they are still pumping the banks with liquidity, that the market in the short term is going to like that. So I promise we're going to get into all of that. I'm going to give you my take on the market as it stands currently. What am I looking at? What can throw a wrench into this new bull market that we see on the NASDAQ? And are we in the clear? The Fed is getting closer to pausing. And what happens historically when the Fed pauses? But before we dive into the video, make sure that you follow me on Twitter and Instagram. Those links are in the description. In the Linktree link, you will see a link to all of my socials. Make sure you follow me on Twitter and Instagram because I send out daily trading and finance content, including trades that I'm taking. I sent this SPX put out, made 81% on this trade. I sent this out on Twitter this morning. It was also obviously in the Academy. We have taught thousands of traders how to trade over the years and are currently transitioning a ton of traders from paper trading futures into real money trading. So make sure you sign up for the Academy to get all of our live trades and analysis every single day. And let's get right into it. So is Michael Burry being sarcastic here in the wake of all of the bank failures, the revised CPIs, the pressure that the US dollar is coming under recently? Honestly, I don't know. I could tell you that when I'm looking at the chart, actually, fuck the chart. Let's not look at the chart. We will definitely look at the chart. But as I was saying on my last live, on my last video, watch a documentary called The Age of Easy Money. But basically, as I was stating, the Fed is, or the market is addicted to the Fed. It's addicted to easy money. It's addicted to quantitative easing. It's addicted to artificial injection of liquidity. And as long as the Fed keeps doing this, and nobody obviously could tell, one, that the banks were going to fail. Nobody could tell that the Fed was going to backstop all of these banks and we're going to buy unlimited amounts of treasury at par and give out loans to the banks however they pleased. But the fact that they did, obviously, we are now driving liquidity back into the system and the market loves that. So since the Fed announced that, it's no surprise to me that the market has been rallying, has been going up. But we are not yet in the clear. Obviously, we made highs during the beginning of February. That is around the time that Michael Burry had said sell. He said sell around January 31st. And in my view, we have a long way to go. Now, obviously, I don't know the extent of the Fed's liquidity injection. If it's going to continue, and that program is open until 2024, as I stated before, the program that backstops all of the banks or any bank that requests it, basically providing an unlimited amount of liquidity into the system to help stop bank failures. That program is open until February or until 2024. This is on the Fed's website here, the Bank Term Funding Program. It says advances can be requested under the program until at least March 11, 2024. Could go beyond that depending on how bad things get. Now, from a purely technical perspective, we broke out of the inverse head and shoulders, but came right back in. That one is a very bullish sign. Coming back in is actually a very bearish sign. And for me, everything from here on out is really data dependent. We see that the Fed funds rate, finally, PCE fell below the Fed funds rate. And, obviously the Fed wants the Fed funds rate above inflation. It's nowhere near above CPI yet, but we are getting closer as it is above PCE. However, we do have PCE being reported on March 31st. If you're watching this before that, then, it's something that you can monitor. If you're watching this after that, then we'll know whether PCE came in higher than expected or not. And if we take a look at the probabilities of the target Fed funds rate, over 50% are now projecting that the Fed doesn't raise in the next meeting in May. Now, this is a completely different picture from where we were a month ago before the banks started failing. Before the banks were failing, there was a projection that the Fed would push rates almost to 6%, and we would not see a rate cut this year. Now we are projecting that there are no more rate hikes, at a 50-50 basis, that there are no more rate hikes. And if we do see a rate hike, we'll do 25 basis points in May and then pause, and then potentially a cut after the summer. Now, I do think in the short term, barring any sort of higher inflation, whether it's PCE or CPI, I do think that the market can actually continue to run in the short term. If you look at this, we are nowhere near the point where there's enough liquidity taken out of the market. This is gearing up to be the second best buy the dip year since 2020, right? But if we compare this to another time where we had high inflation, the late 70s and early 80s, the buy the dip strategy didn't really work because people didn't have that much liquidity to pump these stocks up. However, to me, this points that there is still an insane amount of liquidity in the system. And that is why we're seeing sticky inflation and revised CPIs, etc. However, as long as this continues and the Fed keeps injecting money into the system, I do think that the stock market can continue to run at least to former resistance levels, whether we're talking about the high that we hit in February or the all too commonly looked at 4,300 level on the S&P 500. And to me, that's going to continue until one of two things happen, until we get a major reversal in inflation, right? Seeing inflation going back up, whether it's PCE or CPI or both, or whether something else breaks in the system. We all know that if the Treasury and the Fed didn't come in and backstop the banks, this would have been a completely different scenario that we would be tracking right now. But they stepped in, they supplied the banks with an endless amount of liquidity, and we are where we are. However, if you look at the St. Louis Fed Financial Stress Index, this measures the financial stress and economic conditions that we're currently in, basically taking a ton of data points. I think it's 18 data points, looking at interest rates, looking at yield spreads, etc. This right here, we hit 1.575. And every time we've hit above this level, I think it hit this level 4 times in the last 30 years. Let me go back to a tweet by Cheddarflow. 4 times in the last 30 years. In every case, the VIX hit at least 45. During the last 2 spikes, it actually hit 80. So when the interest rate is hiked that aggressively and the yield spreads are all broken, we tend to see things crack like what we saw with the banks, but there are usually also unresolved credit risks, whether it's in corporate credit or consumer credit or both. We tend to see some type of credit event. So the banks, to me, was just a start. And if we continue to raise rates and keep them there, and inflation does not come down significantly fast enough to where the Fed funds rate is now above CPI, then I do think that this is likely to play out. Not this right here, but the Fed Financial Stress Index, this is likely to cause some sort of event that we just cannot see right now. So from an investor standpoint, in my view, I mean, continuing to buy the dip or dollar cost average is always going to be your best bet, especially the fact that we're still 16% down from all-time highs on the S&P 500. And on the NASDAQ, we are still, we're still almost 22% down from highs. Now, I'm not saying that, if you're looking for the ultimate spot to buy, which is not really how to invest for the long term, I'm not saying this is an ultimate spot to buy, but I'm saying that if you don't want to worry your head about what can happen or can't happen, then yes, of course, buying the dip or dollar cost averaging has always worked, especially in a down market. For me right now, I'm investing in treasuries because the yield is just too good. I'm day trading every single day, which I'm much more comfortable opening and closing positions every single day, and I'm confident in my ability and my skills to do so. And I'm looking at trades like the 2-year note futures, which I mentioned to you months ago, where we caught the bottom from 2007. In my view, if the Fed is actually going to pause, when the Fed pauses, there is a lot of opportunity, more opportunity for me, or more predictable opportunity in the 2-year note futures than there are in stocks. And just as a last note, what happens when the Fed actually pauses? What happens to the stock market? Well, there's a big difference between the Fed pivoting, which in my view means cutting back rates or cutting rates, and pausing. When the Fed pauses, the market can still go up. But when the Fed finally pivots, they pivot because something has cracked where, it's expected that something cracks. They obviously want unemployment to go up. They want spending to stop. But something cracks to where the Fed then realizes or determines that, hey, we cannot keep rates this high. We finally got inflation where we want it. Unemployment is high enough. This thing here in the financial system broke. This thing here cracked under pressure. And they only pivot when things really turn bad. So I personally don't think that the Fed is going to cut until unemployment goes up, for instance, and until we get the Fed funds rate above CPI and above PCE, which it is already above PCE, but we don't know about the next one. But every time that the Fed pivots, or at least in the last few bear markets, so if we talk about before 2020, if we talk about what happened in 2008, if we talk about what happened in the dot-com crash, most of the bear market in those bear markets, most of the decline actually happened after the Fed pivoted. So that is why I don't think that we can achieve a soft landing, in my opinion. I don't know what in the system will break, but just historically, it is not common that the Fed just pivots willy-nilly like that. They're going to pause, and they're going to pause, by the summer, in my view. But I don't think they pivot until things actually start breaking. So, unfortunately, things aren't as clear as they seem on a midterm basis. And I know that you're hearing all kinds of opinions, but to me, it's conditional based on the things that I laid out, and that is why I continue to day trade on a daily basis, because I don't care if it goes up or down. Or sideways. I will find a strategy that works for that, and I will find a strategy that works for me, and we consistently do it. So if you want access to the academy, if you want access to all of our trades and analysis, stocks, options, futures, etc., day trades, swing trades, trades on treasury notes, link is in the description below. Come join us, be a part of the most dynamic online team. We are one of the largest and first finance social groups online. So come and join us. Would love to have you. Leave a comment down below. Let me know what you think of Michael Burry's comments. Do you think he was being sarcastic? Do you think he was being serious? Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.